That was another absolute doozy for stocks, and I worry that folks are not appreciating the magnitude of the situation that we're in right now. Crucially, we did hold the previous lows today, even though we faded so hard from an attempted early rally. What we continue to see are there are two unresolved problems. The two unresolved problems for stocks that I set up earlier this week. One is that tech valuations are too high despite where all the growth is in tech. The other is that the rotation logic of going into cyclical and economically dependent companies when the data are as soft as they are doesn't make sense. Now, the yellow light holds on to stocks. Firstly, look at the technicals, then we'll get into the fundamentals here. If you just look at the price action alone, I mean, there's so much interesting stuff happening on just the last 2 weeks of price action here. The S&P 500 is where it's at right now. I mean, this is the battleground, no question about it. We got a higher low today, just above where we were on Tuesday. That was just above where we were last Thursday. The fact that we're able to string this together here on the margin is the absolute smallest of victories for bulls, but that also means it's possible that we're not in that downtrend. Because keep in mind, this all happens so quickly. If you do describe the S&Ps as a downtrend, which you can because you've got lower highs, that only goes back like 15 days. So you really have to appreciate the short-term stuff here. And ultimately what this does, it makes something more like a wedge than an obvious trend. That leaves hope for tomorrow. The fact that we were able to hold down there above 54, that's the line in the sand. If that breaks tomorrow, then there's real potential we could get wrecked, because right now the logic of the market just doesn't add up. How can you reward Apple for an otherwise solid quarter, though, when it's trading at one of its highest valuations ever? We still don't really know what's on the phone. Tomorrow with employment also puts into perspective what the bond market has been telling us, which so many have been trying to ignore. I don't really get it, why folks are so insistent that this time is different. It's been a while since the yield curve inverted, but it's still within the range of what historically has always worked as a recessionary indicator. The range closes in October, according to Cam Harvey, who invented the study. And what's happening now is the uninversion of the curve, the 10s to the 2s, that's happening so rapidly here is not the one you root for, as I've said many times before. The bull steepening is what happens when the Fed cuts because it needs to help the economy. Now, generally, Powell does seem to be correct in that the risks are pretty balanced with inflation high. That's where every single data point becomes so important now, because if we're at a coin flip for whether or not we're cutting for good reason or bad reason, each incremental negative economic data point suggests we're cutting for a bad reason. And today's data was bad. The manufacturing stayed sluggish, prices were still high, and we saw jobless claims rise to mid-200,000s, highest in a year. If employment is weak tomorrow, and by the way, they're already expecting employment to dip about 25,000 from the previous reading. If that number doesn't give us something good, and you break that 54 and the 10-year yield keeps diving, there's nothing good about that message. So again, like I said yesterday, it's a yellow light with the longest string of caveats, but I'm still rooting for the American economy to print us something surprisingly good tomorrow. But if it doesn't, watch out below. There's really no obvious place to hide when tech is still as expensive as it is. Apple's earnings were just all right. I'll see you in the morning.